In this video, we cover inventory cost flow assumptions, and we will review the financial statements and footnote disclosures of Deere & Company, the manufacturer of the well-known John Deere equipment brand used primarily in construction, agriculture, and forestry. Here's the inventory accounting framework we have developed in videos 33 and 34, which addresses the accounting issues involved with the acquisition of inventory, how it is carried on the books, the cost flow assumptions used at the point of sale, and the application of the lower cost or market rule to ending inventory. In this video, we focus on the three cost flow assumptions used in practice: averaging, first in, first out, FIFO, and last in, first out, LIFO. The cost flow assumption chosen by companies can have a significant effect on how the inventory costs are allocated to ending inventory on the balance sheet and cost of goods sold on the income statement, which in turn affects net income and the income taxes paid by the company. A quick note about income taxes and the cost flow assumption. The guidelines for measuring net income under U.S. GAAP, set forth by the FASB and the SEC, are not the same as the rules in the U.S. for measuring taxable income, which are established by the U.S. Congress and carried out by the Internal Revenue Service, often called the IRS. Thus, on a typical income statement as shown here, net income before taxes, determined based on U.S. GAAP, does not always equal taxable income, the number used to determine a company's income tax liability determined by IRS rules. This means that a revenue or expense on the income statement is not necessarily a revenue or expense on the tax form filed with the IRS. However, in the U.S., there is a rule called the LIFO conformity rule, stating that if a company chooses the LIFO cost flow assumption for tax purposes, it must also use this cost flow assumption for financial reporting purposes. This essentially means that the cost flow assumption choice not only determines net income before tax on the income statement, but also determines taxable income and ultimately the company's income tax liability. We address this issue again later in the video. Let's now turn to an illustration that demonstrates the mechanics involved in applying each of the three inventory cost flow assumptions and highlights their differential effects on both cost of goods sold on the income statement and ending inventory on the balance sheet. We begin our illustration by assuming that three different companies, LIFO, Average, and FIFO, each began operations on January 1, and all three sell fuel oil. To stock their fuel oil tanks during January, each company made three separate fuel oil purchases prior to making any sales. On January 1, each company purchased 20 gallons of fuel oil at $1 per gallon, a total cost of $20. And each company placed the oil into its own single holding tank. On January 9, each purchased 10 gallons at $2 per gallon. Again, a total cost of $20. Again, pouring it into the holding tank. On January 20, each purchased 20 more gallons of fuel oil at $3 per gallon, this time a total cost of $60, and again into the tank. Note that the input cost per gallon has been rising throughout January from $1 to $2 to $3. Keep in mind as we go through the illustration that the input market, the market from which these companies are buying their fuel oil, is experiencing inflation. Up to this point, in total, all three companies have purchased 50 gallons of fuel oil for a grand total purchase cost of $100, and all 50 gallons are contained in their own single holding tanks. Assume further that each company made a sale on January 25, selling 15 gallons of fuel oil at $5 per gallon, collecting $75 for the sale, and withdrawing the oil from the single tank. And at the end of January, the purchase and sales activity during the month left 35 gallons of fuel oil in each tank, which represented January's ending inventory in units, which in this case is gallons. Let's prepare an income statement and an ending inventory dollar amount, which would appear on the balance sheet for January for each of the three companies, LIFO, Average, and FIFO. Note first in this example that there is no way any of the three companies can tell with certainty which purchase batch the 15-gallon sale on January 25 came from, because the 15 gallons were withdrawn from a single tank that held all three purchases. They all know that the sold oil came from the 50 total gallons purchased during January, but it is impossible to tell whether the sold oil was purchased on January 1 at $1 per gallon, on January 9 at $2 per gallon, or on January 20 at $3 per gallon. The purchases are indistinguishable within each company's single holding tank. Consequently, each company will be forced to make an assumption about the inventory cost flow, LIFO, Average, or FIFO. Having to make this kind of assumption is not unusual for large companies with operations spread out all over the world. We know that all three companies would report sales for January of $75. And let's assume that each company incurred selling, general, and administrative expenses, SG&A expenses, of $20 during the month, and pays income taxes at a rate of 40% of net income before tax. Focusing first on the last in, first out LIFO company. Here, management assumed that oil from the last in, most recent January 20 purchase was sold first, meaning the cost of goods sold came from the January 20 purchase at $3 per gallon, $45, 15 gallons times $3. And ending inventory is valued at $55, containing 20 gallons at $1 per gallon, plus 10 gallons at $2 per gallon, plus 5 gallons at $3 per gallon, for a total of 35 gallons at $55. Note importantly that if you add the $55 ending inventory balance to the $45 cost of goods sold balance, you get the $100 inventory purchase cost. To complete the income statement, the LIFO assumption leads to a gross profit of $30, a net income before tax of $10, an income tax expense of $4, and a bottom line net income after tax of $6. Moving to the average company. Here, management assumed that all sales and ending inventory units, or gallons in this case, are valued at the $2 average purchase costs, $100 divided by 50 gallons purchased, leading to a cost of goods sold of $30, 15 gallons times $2, and an ending inventory of $70, 35 gallons times $2 per gallon. Again, the $30 cost of goods sold plus the $70 ending inventory accounts for the entire $100 purchase cost. And completing the income statement leads to a bottom line net income after tax of $15. Note that under averaging, both ending inventory and net income are higher than under the LIFO assumption. Focusing finally on the first in, first out FIFO company, here management assumed that the first in, oldest January 1 purchase was sold first, meaning that cost of goods sold came from the January 1 purchase at $1 per gallon, $15, 15 gallons times $1. And ending inventory is $85, consisting of 20 gallons at $3 per gallon, plus 10 gallons at $2 per gallon, plus 5 gallons at $1 per gallon, for a grand total of 35 gallons valued on the balance sheet at $85. Note again that adding cost of goods sold of $15 to ending inventory of $85 accounts for the entire $100 inventory purchase cost. This has been true in all three cases, highlighting the fact that the cost flow assumptions are just different ways to allocate the purchase costs between cost of goods sold and ending inventory. Completing the FIFO income statement, the FIFO assumption leads to a gross profit of $60 and net income before tax of $40 and an income tax expense of $16 and a net income after tax of $24. Now to a few comparisons across the three companies. Comparing the ending inventory and net income after tax values across the three assumptions, we see that FIFO results in the highest values, LIFO the lowest values, and the average values are in the middle. It is important to understand, though, that these differences result from the fact that the inventory purchase costs in the input market are experiencing inflation. Costs are rising. While in general costs tend to rise across time, they do not always rise in all markets across all periods of time. Had input costs been constant, say $2 across each purchase, there would have been no differences across the three companies. All would have reported net income after tax of $15 and ending inventory of $70. Or had input costs been decreasing, $3 per gallon on January 1, $2 on January 9, and $1 on January 20, the differences would have been reversed. LIFO would have reported the highest values and FIFO the lowest. We continue our illustration assuming inflation because historically input costs have gone up. Just keep in mind that in a given year or a given market, input costs sometimes go down. The differences illustrated here tend to represent the reported differences that result from the cost flow assumption choice made by different companies. That is, holding other factors constant, companies that use FIFO tend to report higher profits and higher ending inventories than companies that use LIFO. That brings us to a few observations about the cost flow assumption choice. First, U.S. companies are generally allowed to choose any of the three cost flow assumptions, and it is not necessary that the assumption chosen match the actual physical flow of the inventory. However, once an assumption is chosen by a company, the company must stick with it. It is very difficult to make a change. Companies are not allowed to change assumptions from one period to the next. A second interesting point is that IFRS does not allow LIFO. Companies that use IFRS can only choose from the average and the FIFO assumptions. A few of the comments we make later may help to explain why IFRS does not support LIFO. A third observation: if a company in the U.S. chooses LIFO for reporting on its tax forms to the Internal Revenue Service, which is allowed by the IRS, and often desirable because over time, given inflation, it leads to lower taxable income and lower taxes, the company must also use LIFO for purposes of preparing the financial statements reported to the shareholders. This U.S. rule, called the LIFO conformity rule, ensures that if a company seeks a tax benefit by choosing LIFO, it must also report the LIFO net income number on its income statement, a number that is normally lower than the FIFO assumption would have produced. Thus, the public, shareholders, and others see a lower net income number. Let's focus for a moment on the tax benefit associated with LIFO compared to the average and FIFO assumptions. Let's assume in our illustration that all three companies began January with $200 in cash, and that all transactions during January were in cash. Each company spent $100 purchasing inventory, collected $75 in sales, and paid $20 in selling general administrative expenses. The only difference is that the LIFO company only paid $4 in taxes, while the average and FIFO companies paid $10 and $16 respectively in taxes. Thus, the ending cash balance for the LIFO company is higher than the others. Does this mean that LIFO is the most popular inventory cost flow assumption used by U.S. companies? Currently, all three assumptions are common in practice in the United States. Let's talk a bit more about some of the trade-offs involved in choosing one of the assumptions as opposed to the others. A useful way to address that question is to view the differences between FIFO and LIFO by thinking of the FIFO assumption as an assembly line and the LIFO assumption as a coal pile. In the FIFO assembly line, in quotes, purchase units enter the line and move along to the end of the line where they are sold to the customer. In this depiction, the units with the older, normally lower cost are assumed to be sold to the customer, while the units with the newer, more current cost remain in ending inventory. Thus, cost of goods sold on the income statement is made up of the older, normally lower costs, while ending inventory on the balance sheet is comprised of newer, more current, and normally higher costs. In the LIFO coal pile assumption, purchases are placed on the top of the pile, and sales to the customer are also removed from the top of the pile. This creates layers of inventory costs because as companies grow, inventory purchases exceed inventory sales, meaning with each passing year of growth, then a layer is added on to the pile. This means that virtually all of the activity, purchases, and sales are assumed to take place at the top of the pile, leaving ending inventory comprised of old, and over time sometimes very old costs. Cost of goods sold, on the other hand, is comprised of current, up-to-date costs. Thus, under the two assumptions, the costs comprising cost of goods sold and ending inventory come from the opposite sides of the assumed inventory flow. This picture highlights three disadvantages associated with the LIFO assumption. Disadvantages that cause many companies to choose FIFO and/or averaging, and perhaps explain why LIFO is not acceptable under IFRS. First, for the huge majority of companies, a coal pile, in quotes, does not accurately describe the physical flow of the inventory. Virtually all companies try to sell their inventories as soon as possible, attempting to minimize the number of older, outdated inventory units. The second reason is that over time the costs comprising ending inventory in the balance sheet increasingly become more and more outdated, rendering them much less useful and often grossly understating the balance sheet value of inventory. Finally, when long-term LIFO users attempt to reduce their inventories by allowing inventory sales to exceed purchases, often trying to save money by ridding themselves of slow-moving and obsolete inventory items, the older LIFO layers are invaded, which means that these very old, very low costs become part of cost of goods sold, which in turn can increase net income by large amounts. This phenomena is called a LIFO liquidation, and it can be very costly to long-time LIFO users because the inflated income number, which is only inflated due to the inventory liquidation and not because the company had a good year, drives up the company's tax liability. Let's complete the video by taking a look at Deere & Company's financial statements and footnotes. Here's the assets section of Deere's 2016 balance sheet. It shows an inventory balance of $3.3 billion, about $500 million less than 2015's $3.8 billion balance. Deere's 2016 income statement, called the Statement of Consolidated Income, shows cost of goods sold for 2016 of $18.2 billion, which is 78% of the net sales number. This means that on average, Deere marks its products up about 28%, $23.387 billion divided by $18.249 billion, 1.28, over its costs. Note too that Deere's 2016 provision for income taxes was $700 million, which is 31.5% of its income before taxes here called income of consolidated group before income taxes. $700 million divided by $2.24 billion. This means that Deere's effective income tax rate for 2016 was 31.5%, an important percentage that we will refer to later in the video. Now to Deere's inventory footnote number 15. It discloses that Deere relies primarily on the last in, first out inventory cost flow assumption for over 60% of its inventories. First in, first out, valued at lower of cost or market, is used for the remaining inventories. Some of these FIFO basis inventories are likely subsidiaries of Deere, many of which are not in the U.S., where LIFO is not an accepted assumption. Recall that LIFO is not accepted under IFRS. Interestingly, during 2016 and 2015, Deere experienced a LIFO liquidation that boosted 2016 and 2015 net income by $4 million and $22 million respectively. This is a required disclosure of all LIFO users, warning readers that some of Deere's income for 2016 and 2015 was due to the liquidation. And note that it is consistent with the overall dip, $476 million in the inventory balance from 2015 to 2016. As we look to the inventory balances at the bottom of the footnote, we see that Deere breaks the total balance sheet inventory dollar amount down into raw materials, work in process, and finished goods, just as Caterpillar did in video 34. But here we also see that Deere discloses the difference between the LIFO basis number on the balance sheet, $3.341 billion, and what inventories would have been had they been reported on a FIFO basis, $4.798 billion, a much higher number, by almost $1.5 billion. This difference is called the LIFO reserve. It is a required disclosure for all LIFO users. And now we will show that it provides some very useful information. For example, the LIFO reserve enables readers to estimate what Deere's 2016 net income would have been had it used FIFO for all of its inventories. If we take another look at footnote 15, we see that the LIFO reserve increased by $31 million from 2015 to 2016. This means that during 2016, the amount by which FIFO inventory exceeded LIFO inventory increased by $31 million. Multiplying this $31 million increase by 1 minus the effective income tax rate, computed earlier on Deere's income statement to be 31.5%, we get $21.2 million, which is the difference between 2016 net income under LIFO reported on the 2016 income statement and what 2016 net income would have been had Deere used FIFO for all of its inventories. Thus, adding the $21 million difference to Deere's 2016 LIFO net income gives us a 2016 net income that Deere would have reported had it used FIFO for all of its inventories, $1.545 billion. In summary and in general, net income reported under LIFO for a given year, plus the increase in the LIFO reserve, or less the decrease in the LIFO reserve, multiplied by 1 minus the effective tax rate, equals net income under FIFO for the same year. This calculation is very useful because it allows the readers to validly compare Deere's net income to other companies who use FIFO. For example, the Japanese manufacturer Komatsu, a FIFO user, is a primary competitor of Deere's. Komatsu's net income for 2016 was approximately $100 million. Since it was based on using the FIFO assumption, the FIFO adjusted 2016 net income number of $1.545 billion would have been a more valid number to use when comparing Deere's performance to the performance of Komatsu. using the $1.524 billion reported on Deere's income statement, which is based largely on LIFO, would have been like comparing apples to oranges. Other interesting information can also be computed using the LIFO reserve. Some have argued, for example, that U.S. companies should be required to adopt IFRS, which would mean that companies like Deere would no longer be able to use LIFO. If these companies were forced to switch to FIFO, in the year of the switch, they would report additional net income and have to pay additional income taxes. We can compute the additional income they would report in 2016, for example, by simply looking at the 2016 LIFO reserve of $1.457 billion. If Deere switched to FIFO in 2016, inventory would go up by $1.57 billion, the LIFO reserve, to $4.798 billion, and a $1.57 billion gain would be recognized on the income statement associated with the change to FIFO. This switch, however, would lead to additional income taxes, which can be computed by multiplying the LIFO reserve by the 31.5% effective tax rate, leading to $459 million of additional 2016 income taxes, providing one reason at least why companies like Deere might not be too keen on switching to FIFO. The additional taxes would lead to an entry that recognized both tax expense and tax liability. And the combination of these two entries would lead to an increase in Deere's reported 2016 after-tax net income of $998 million.